Hey guys, welcome back. In today's video, we're diving deep into the current state of AMC and the short-selling landscape, and you're going to see why shorts are drowning in debt, why the AMC floor price is so important, and why the short squeeze season could be just around the corner. First, let's take a look at the broader picture. When we examine AMC alongside other theater companies like Cinemark and IMAX, the differences in market performance are striking. AMC is down 2.24%, while Cinemark is up 1.25%, and IMAX has remained relatively stable. This contrast shows us immediately that AMC is not moving in line with the market, despite the box office performance and the overall growth that other theaters are enjoying. In theory, if all these companies were benefiting from increasing box office revenue, AMC should be showing similar gains. Yet it doesn't, and that discrepancy tells us something important. AMC's stock price is being manipulated. The everyday fluctuations in AMC's price are not reflective of its actual business performance, and this manipulation is one of the clearest indicators that short sellers are under tremendous pressure. If you've seen articles suggesting that AMC shouldn't be bought or that competitors are better investments, now you know the reason why. These pieces are not random. They are part of a coordinated attempt to suppress retail buying interest and keep AMC undervalued. One of the biggest reasons for this manipulation is the ongoing financial strain on major short sellers, particularly Ken Griffin. Reports indicate that Griffin is drowning in interest on his swap positions and is facing massive losses on his AMC and GME shorts. His financial position is precarious, and the consequences of this are rippling through other hedge funds and institutions. Over the past few months, we've witnessed a series of events with Citadel, including internal trading pods blowing up and the forced liquidation of highly leveraged positions. Citadel has been losing month after month, which is highly unusual for a firm that is supposed to generate billions in annual profits. These losses reveal that risky positions have been taken, and the institutions holding them are now trapped, unable to unwind without catastrophic consequences. What makes this even more striking is that Citadel and other large firms have been publicly complaining about everything from the CAT system to private trading rooms and even dark pools. They have argued that retail investors don't have an edge over institutional traders, essentially attempting to downplay the influence and strategy of individual investors. This is telling because a company supposedly making tens of billions per year wouldn't need to raise money or borrow funds if its profits were as reported. The fact that institutions are seeking additional capital shows that risky positions are seriously impacting their liquidity. Some positions have been forced closed to prevent further losses, but others cannot be closed at all without triggering bankruptcy. Central to this issue are the AMC and GME short positions, which have become high-risk, high-stakes financial traps. Another key factor keeping shorts trapped is the AMC floor price. AMCfloor.com has recently updated its figures, and while there's no precise formula behind these numbers, the concept is very telling. Considering AMC's historic 2021 run, which was capped at $700 per share adjusted for reverse splits, and CEO Adam Aron's 2022 guidance of $250, the new floor price of $4,269 may sound extreme, but it's not entirely unrealistic. There's clearly some joking sentiment in the number, yet it also reflects the underlying potential for AMC to reach extraordinary levels under the right conditions. When you consider the factors at play, naked short selling, dark pools, spoofing, market manipulation, and other forms of institutional interference, it becomes clear that AMC has an opportunity to break far beyond historical limits. Furthermore, AMC's growing revenues, diversified streams of income, and the potential for dividends only strengthen the case for a higher floor price. These fundamentals, combined with the extreme pressure on short sellers, create a perfect storm for dramatic upward movements in the stock. If institutions like Citadel are forced to buy back the billions of AMC shares they have created or borrowed, and they must do so at a price as high as $4,200 per share, the consequences could be catastrophic for them. We could see multiple hedge funds go bankrupt, and this could even ripple out to banks that act as prime lenders in these trades. This scenario explains why there has been such caution and delay in regulation. Regulators are aware of the potential fallout from forcing short sellers to cover their positions, so they move slowly to avoid destabilizing institutions. At the same time, retail investors remain largely unaffected by these delays because AMC's fundamentals and market position continue to strengthen. Understanding this dynamic is critical. While institutions try to suppress AMC's price, the stock's inherent value and potential for growth remains strong, setting the stage for the next phase in what many are calling the short squeeze season. The broader takeaway is that AMC is not just another stock, it's a focal point where market manipulation, institutional risk, and retail investor activity intersect. The stock's underperformance relative to its peers, the struggles of hedge funds like Citadel, and the extraordinary floor price projections all point to one conclusion: AMC has the potential to reach new highs, and those holding short positions are in extremely precarious situations. Every forced liquidation, every attempt at manipulation, and every misleading news article only adds pressure to the system. In the next part of our discussion, we'll explore how media narratives and retail sentiment play into this, and why the short squeeze season could impact not just hedge funds, but the broader financial landscape as well. For now, the key takeaway is clear. AMC's current position is a unique and volatile intersection of potential, risk, and opportunity, and understanding the forces behind it gives us a better perspective on what's coming next. One of the most important developments to consider is the growing chatter around the short squeeze season, particularly from influential voices like Charles V. Payne. Payne has been very vocal about AMC and GME, frequently highlighting market manipulation, the dangers for short sellers, and the potential for significant squeezes. When he mentions a short squeeze season, it's unlikely he is speaking generically. This is a clear signal pointing toward high-profile stocks like AMC and GME. His comments reflect broader market dynamics where hedge funds and institutions, including Citadel, are increasingly vulnerable due to a combination of forced short positions, margin pressure, and synthetic shares. These factors have created a severe liquidity crunch for major players, which is exactly why short sellers are feeling the heat and why retail investors need to pay attention. At the same time, news articles and media narratives are strategically shaping retail sentiment. Headlines such as "3 reasons to avoid AMC stock" and "1 rival to buy instead" are not merely opinion pieces. They are part of a coordinated effort by institutions to suppress buying pressure. While AMC is down 2.24%, Citadel is up 1.25%, and IMAX remains stable. The narrative targeting AMC is much more aggressive. You don't see equivalent warnings against Citadel or IMAX, even though these companies operate in the same market and face similar macroeconomic conditions. This selective targeting is deliberate and designed to create fear, uncertainty, and doubt among retail investors, making them second-guess their positions and potentially sell prematurely. This phenomenon is not limited to AMC. GameStop has been experiencing a similar media strategy. Despite raising substantial capital, holding massive cash reserves, and positioning itself for strategic growth, GME has been subjected to headlines suggesting investors should sell. Messages like "time to sell GME" are crafted to act as both a call to action and a subtle psychological nudge, influencing retail behavior without appearing overtly manipulative. The goal is to reduce buying pressure and generate a negative sigma effect affecting the perception of value among retail traders. These tactics are consistent with what we see on AMC, where misinformation and fear-based narratives are used to counteract legitimate buying interest and prevent the natural price discovery that would occur if shorts were forced to cover. The combination of these factors, tight liquidity among short sellers, the creation of synthetic shares, massive interest on borrowed positions, and negative media influence sets the stage for a significant market event. Retail investors, however, are uniquely positioned because they are not leveraged to the same extent, allowing them to withstand pressure that would crush hedge funds and other institutions. As institutions scramble to cover billions of borrowed or synthetic shares, the potential for rapid upward price movements becomes very real. Each forced buyback increases demand exponentially, and because the supply of tradable shares is limited, the resulting pressure can quickly escalate, creating a short squeeze of unprecedented scale. Another key aspect is the psychological and strategic advantage held by retail traders. While institutions are weighed down by margin requirements, interest payments, and regulatory scrutiny, retail traders can act collectively and strategically, amplifying the effects of any squeeze. The media attempts to dissuade investors through selective reporting and fear-inducing